Hello and welcome to the only finance channel designed to put you to sleep. In 2008, millions of people went to work, paid their mortgages, did everything right, and still lost their homes, their savings, and their jobs. Not because of anything they did, because of decisions made by people they had never met, in buildings they had never entered, using products they had never heard of. Tonight we go through exactly what happened and why it matters for you right now. Get comfortable. Part 1. The American housing market. How the bomb was built. To understand 2008, you have to start in the late 90s. Not because the crisis began then, it did not, but because the conditions that made it possible were assembled over roughly a decade, slowly and with enormous enthusiasm from almost everyone involved. The United States has a cultural relationship with home ownership that goes beyond finance. Owning your home is the American dream in its most literal form. It represents stability, respectability, arrival. Successive governments, both Republican and Democrat, pursued policies designed to increase home ownership rates. The implicit message from Washington throughout the 1990s and early 2000s was that more Americans owning homes was straightforwardly good, and that expanding access to mortgages was a way of expanding the middle class. In 2001, the Federal Reserve cut interest rates dramatically in response to the dot-com crash and then the September 11th attacks. The federal funds rate, the rate at which banks lent money to each other overnight, and the benchmark for most consumer borrowing, dropped from 6.5% in 2000 to 1% by 2003. This was the lowest it had been in decades, and at 1%, borrowing money was essentially free. When borrowing is cheap, people borrow, and in the early 2000s, they borrowed mostly to buy houses. Housing prices began to rise, not dramatically at first, a steady, consistent, seemingly inexorable increase that made owning a home look like the safest investment available. The price of a home in the United States rose by roughly 80% between 1997 and 2006. In some markets, Florida, California, Nevada, Arizona, prices more than doubled. Rising prices created a self-reinforcing narrative. Houses always go up. Real estate is safe, you cannot lose money on property. This narrative was repeated by financial advisors, by real estate agents, by politicians, by television programs dedicated to the pleasures of buying and renovating homes, and by ordinary people who were watching their biggest asset appreciate year after year. The narrative was so pervasive and the recent history so consistent with it that questioning it felt not just wrong but almost anti-American. And so people bought. They bought houses they could afford. They bought bigger houses than they needed because prices were rising and a bigger house was a better investment. They bought second homes, they bought investment properties, and crucially, this is where the mechanics of the crisis begin. They bought houses they could not really afford, with loans that were designed to make the unaffordable seem manageable in the short term. The housing market in the early 2000s was a perfect storm of conditions. Cheap money from the Federal Reserve, rising prices that made everyone feel rich and confident, a cultural narrative that homeownership was not just good but impossible to fail at, a government actively encouraging expanded mortgage access, and a financial industry that had figured out a way to make enormous amounts of money from lending to people who could not really afford to borrow. That last element, the financial industry and its innovation, is where the crisis really lives. And it requires understanding a few specific things about how mortgages work and how they were transformed in the years leading up to 2008. Part 2. The subprimes, what they actually were. A mortgage is a loan. You borrow money to buy a house. you repay the money over time with interest. If you stop making payments, the lender can take the house. This is the basic structure that has existed for centuries. The traditional mortgage market worked on a straightforward principle. Lenders lent money to people who were likely to pay it back. They checked income, employment history, credit history, the value of the property relative to the loan. They required meaningful deposits, typically 20% of the purchase price. And they held the mortgage on their own books, meaning that if the borrower stopped paying, the loss was the lender's problem directly and personally. The system had obvious conservatism built in. Lenders who bore the risk of default had strong incentives to lend only to borrowers who were likely to repay. The system was not perfect, but it was self-regulating in an important way. Beginning in the 1990s and accelerating dramatically in the early 2000s, this changed. Two things happened simultaneously that fundamentally altered the incentives in mortgage lending. The first was the rise of the subprime market. Subprime refers to borrowers who do not qualify for standard prime mortgages, people with poor credit histories, low or variable incomes, high existing debt levels, or no meaningful savings for a deposit. Traditionally, these people could not get mortgages. Now they could. Not because their financial situations had improved, but because the mortgage industry developed new loan products specifically designed to lend to them. The most notorious of these products were the adjustable rate mortgages, ARMs, with teaser rates. The structure worked like this. A borrower would be offered a mortgage with a very low initial interest rate, sometimes as low as 2 or 3%, for an introductory period of 2 or 3 years. After that period, the rate would reset to a much higher level, typically based on a variable benchmark, plus a spread that could push the effective rate to 8, 9, 10% or more. At the initial teaser rate, the monthly payments were manageable. Even for a borrower with modest income, a 2% rate on a $300,000 mortgage might produce payments that seemed affordable. The pitch was that by the time the rate reset, the borrower's income would have increased, or they could simply refinance into a better loan. Or, and this was the crucial assumption, property prices would have risen enough that they could sell the house at a profit if needed. This last assumption was the load-bearing wall of the entire structure. If house prices kept rising, the system worked. Borrowers who could not afford the reset rate could sell their homes and pay off their mortgages with money to spare. Lenders would get their money back. Everyone would be fine. The assumption was not hidden, it was explicit. The entire subprime mortgage market was built on the premise that house prices would continue to rise indefinitely. When you understand that, you understand why the whole thing collapsed the moment prices started falling. Not because something unexpected happened, because the one thing the entire system required to function turned out to be untrue. There were products that took this to extraordinary extremes. Ninja loans, no income, no job, no assets, were mortgages issued to people who literally provided no evidence of any ability to repay. Stated income loans, sometimes called liar loans, allowed borrowers to state their income without verification. Interest-only mortgages required no principal repayment at all for the initial period. Negative amortization mortgages allowed monthly payments so low that the outstanding balance actually increased over time rather than decreasing. These products were not obscure corner cases, they were mainstream. By 2006, roughly a quarter of all mortgages issued in the United States were subprime. In some markets, the percentage was much higher. The standards for mortgage lending in the United States in the mid-2000s were, by any historical measure, extraordinarily low. Almost anyone could get a mortgage. and millions of people did. The question you might be asking is, why would any lender do this? Why would a bank lend money to people who clearly could not repay it? What was in it for them? The answer to that question requires understanding the second major change in mortgage lending that happened in the same period. The change that transformed the incentive structure of the entire industry and turned a bad mortgage from the lender's problem into someone else's problem. That change is called securitization, and it is where the crisis really begins. Part 3 is securitization, how they packaged the bomb. Here is the concept that underpins the entire 2008 financial crisis. The concept that changed everything about how mortgages worked and who bore the risk of them going wrong. Traditionally, the bank that made a mortgage loan kept that loan on its books. The bank owned the mortgage. The bank received the monthly payments. And if the borrower defaulted, the bank bore the loss. This created a direct alignment between the lender's incentives and the quality of the loan. A loan that goes bad costs the lender money, so the lender has a strong incentive to make good loans. Securitization broke this alignment. It worked like this. A mortgage lender, let us call it a mortgage originator, makes 1,000 home loans. Instead of holding these loans on its balance sheet, it sells them to an investment bank. The investment bank bundles these 1,000 mortgages together into a single financial product, a mortgage-backed security or MBS. This product is essentially a bond. The cash flows from the 1,000 underlying mortgages, the monthly principal and interest payments, flow through to the investors who own the MBS. The MBS is then sold to investors around the world, pension funds, insurance companies, banks in Germany, hedge funds, sovereign wealth funds in Norway and Singapore. From the mortgage originator's perspective, this was a beautiful arrangement. They made a loan, they immediately sold it. The risk of the loan going bad was no longer their problem. It was the problem of whoever bought the MBS. And since the risk was gone, why worry too much about the quality of the loan? Make as many loans as possible, collect the origination fees, sell them off, and repeat. The business model shifted from making good loans to making as many loans as possible. This is called the originate to distribute model, as opposed to the traditional originate to hold model. And it produced a catastrophic misalignment of incentives. The people making the loans had no interest in whether the loans would be repaid. The people bearing the risk of default, the MBS investors, were far removed from the underlying borrowers and had no visibility into the quality of what they were buying. From the investment bank's perspective, bundling mortgages into MBS was extraordinarily profitable. They charged fees for structuring the products, fees for distributing them, fees for servicing them. And they could create vast quantities of these products as long as mortgage originators kept producing loans to bundle. The investment banks had strong incentives to encourage the origination of as many mortgages as possible, including subprime mortgages, which typically carried higher interest rates and therefore generated higher yielding MBS that investors were willing to pay more for. The investment banks were not neutral intermediaries passively bundling mortgages that happened to exist. They were active participants in encouraging the production of the underlying loans, including the worst ones, because those loans were the raw material for the most profitable products they could sell. From the investor's perspective, the pension fund, the insurance company, the German bank, mortgage-backed securities looked attractive. They offered higher yields than government bonds. They were described as backed by real assets, American houses, which always went up in value, and they were rated as safe by the major credit rating agencies. Which brings us to one of the most important and most infuriating elements of the whole story. Part 4. The CDOs, the bomb inside the bomb mortgage-backed securities, were complicated enough, but the financial industry, in its relentless creativity, did not stop there. They built a second layer of complexity on top of the first, and then, in some cases, a third layer on top of the second. Here is the problem that CDOs, collateralized debt obligations, were designed to solve. When you bundle 1,000 mortgages into an MBS, some of those mortgages are better than others. Some borrowers are more creditworthy, some properties are in better locations, some loans have lower loan-to-value ratios. A sophisticated investor looking at an MBS might reasonably want exposure to only the higher quality slice of that bundle, not the riskier parts. The solution was tranching. The cash flows from the underlying mortgage pool were divided into layers, tranches, with different risk and return profiles. The senior tranches received payments first and absorbed losses last. They were the safest. The junior tranches received payments after the senior tranches and absorbed losses first. They were the riskiest. This structure meant that even if some mortgages in the pool defaulted, the senior tranches would still receive their payments as long as defaults did not exceed a certain threshold. The senior tranches of well-structured MBS could legitimately be rated AAA, the highest possible credit rating, the same rating as US government bonds. This was mathematically defensible under certain assumptions about the correlation of defaults. The idea that if one mortgage defaulted, it did not make it more likely that others in the pool would also default. Those assumptions turned out to be catastrophically wrong, but that is getting ahead of the story. The problem with the tranching of MBS was that it produced large quantities of middle tranches. The BBB-rated slices too risky to be sold as AAA, but too complicated to be easily offloaded. And this is where CDOs come in. A CDO took these BBB tranches from multiple MBS pools and bundled them together into a new product, and then tranched them again. The genius, or the catastrophe depending on your perspective, was that by combining many BBB tranches and retranching them, you could mathematically argue that the senior tranche of the CDO deserved a AAA rating. You were taking the riskiest slices of risky mortgage pools, combining them, and somehow producing a product that the rating agencies would certify as completely safe. And then there were synthetic CDOs, which did not contain actual mortgages at all. They contained credit default swaps, which are essentially insurance contracts on mortgage bonds. A synthetic CDO could create exposure to the mortgage market without actually owning any mortgages, which meant that for every bad mortgage in America, it was possible to create multiple bets on that mortgage through synthetic CDOs. The potential losses from the mortgage market were not limited to the actual value of the underlying mortgages. They were multiplied through the derivatives market. The complexity of these products was extraordinary. The models used to value them ran to thousands of lines of code and depended on assumptions about correlation and default rates that had never been tested in a genuine housing downturn. The people selling them often did not fully understand them. The people buying them, the pension funds, the insurance companies, the foreign banks, certainly did not. And the people rating them, as it turned out, did not either. PAT 45, the rating agencies, the conflict at the heart of the system. In the financial system, credit rating agencies play a critical role. Their job is to assess the creditworthiness of financial products, to tell investors how likely it is that a bond or security will pay what it promises to pay. 3 major agencies, Moody's, Standard & Poor's, and Fitch, are trusted intermediaries whose ratings are embedded in regulations, investment mandates, and the fundamental plumbing of the financial system. Many institutional investors are required by their mandates to hold only AAA-rated securities. Pension funds cannot hold junk bonds. The rating agencies told investors that enormous quantities of mortgage-backed securities and CDOs were AAA safe. They were wrong. Spectacularly, catastrophically wrong. And the reason they were wrong is not complicated. It is one of the clearest examples of a structural conflict of interest producing predictable and devastating consequences. The rating agencies were paid by the issuers of the securities they rated. The banks creating MBS and CDOs paid Moody's, S&P, and Fitch to rate their products. This created an obvious problem. If a rating agency gave a bank's product a lower rating than the bank wanted, the bank could take its business to a competing agency that might be more generous. The agencies were therefore in competition with each other to provide ratings that issuers found acceptable while maintaining enough credibility with investors that their ratings were trusted. This competition for issuer business, called ratings shopping, produced systematic inflation of ratings. The agencies had financial incentives to rate products more generously than the underlying risk warranted, and the models they used to rate mortgage-backed products were based on historical data from a period when house prices had never fallen nationally in the United States. The models literally could not properly price the risk of a nationwide housing decline because it had never happened in the data they were using. Internal emails from the major rating agencies, revealed in subsequent congressional investigations, showed that analysts knew the ratings were problematic. In one famous exchange from Moody's, an analyst wrote that a deal was structured by cows and that rating agencies continued to rate it and the investors would keep buying it. The private acknowledgement that the products were questionable coexisted with the public ratings that certified them as safe. Why did they continue? Because the business was enormously profitable. The rating agencies made hundreds of millions of dollars from rating mortgage-backed products, structured finance, the category that included MBS and CDOs, became a dominant part of their revenue. The financial incentive to keep rating and to keep rating generously was enormous. And so the ratings continued. AAA on products built on INJA loans. AAA on CDOs constructed from the riskiest tranches of pools of subprime mortgages. AAA on products that the people creating them privately described as garbage. The ratings were the crucial link that allowed these products to travel from the mortgage originators in Florida and Nevada through the investment banks on Wall Street and into the portfolios of pension funds and insurance companies in Norway and Germany. Without the AAA ratings, conservative institutional investors could not have bought these products. With them, they did in enormous quantities. Part 6. Leverage. Why the banks were so fragile. We have talked about the products. Now, let us talk about the banks themselves and why, when things started to go wrong, they went wrong so catastrophically and so fast. Leverage is borrowing. When you use leverage, you are investing more money than you actually have by borrowing the difference. If you have 100,000 euros and you borrow 900,000 euros, your leverage ratio is 10:1. You have 10 euros of investment for every 1 euro of your own money. The return on your investment is amplified. If the investment increases by 10%, you make 100,000 euros, 100% return on your actual capital. If the investment decreases by 10%, you lose 100,000 euros, everything you had. If it decreases by 11%, you have lost everything and you owe your lenders 10,000 euros more than you have. In the years leading up to 2008, the major investment banks on Wall Street were operating with leverage ratios of 30, 40, sometimes 50 to 1. Lehman Brothers, in the months before it collapsed, had a leverage ratio of approximately 33 to 1, which means that a 3% decline in the value of its assets was sufficient to wipe out all of its equity, all of the actual money the firm had, and render it insolvent. Let that sink in for a moment. 3%. The largest investment banks in the world were structured in a way that made them insolvent if their assets declined by 3%. How did this happen, and why were these leverage ratios allowed? The answer involves both deliberate regulatory choice and the bank's successful avoidance of regulatory oversight through the use of off-balance sheet structures. In 2004, the Securities and Exchange Commission in the United States changed its rules to allow the largest investment banks to use their own internal models to calculate how much capital they needed to hold against their risks. This was called the Basel II framework in its international version. In practice, it allowed banks to dramatically reduce the capital they held relative to their assets and correspondingly increase their leverage based on models that their own risk departments had built. The models, of course, suggested that the banks were less risky than they actually were, because the models used historical data from a period of benign conditions. Because the models did not adequately account for the correlation risk that caused all assets to fall simultaneously in a crisis. And because the banks had powerful incentives to build models that allowed them to hold less capital, since capital is expensive and leverage amplifies returns in good times. There was also the shadow banking system, financial entities that performed bank-like functions but were not subject to bank-like regulation. Special purpose vehicles, structured investment vehicles, money market funds. These entities borrowed short-term in the wholesale money markets and invested in longer-term, higher-yielding assets, including mortgage-backed securities. They were doing something economically similar to what banks do, borrowing short and lending long, but without the regulatory requirements that applied to banks. And they were enormous. By 2008, the shadow banking system was roughly the same size as the traditional banking system. The combination of extreme leverage at the banks and an enormous unregulated shadow banking system meant that when the underlying assets, the mortgage-backed securities, the CDOs, started to lose value, the losses were amplified through a financial system that had almost no buffer to absorb them. And it meant that confidence played an outsized role, because leverage works on both sides. When everything is going up, 30 to 1 leverage produces extraordinary returns. When confidence falters and creditors start to question whether their loans will be repaid, 30 to 1 leverage produces a death spiral. The bank has to sell assets to repay lenders. Selling assets drives prices down. Lower prices mean more assets need to be sold, which drives prices down further, which causes more creditors to demand repayment. This dynamic, called a deleveraging spiral or a fire sale, is what happened in September 2008. And understanding the leverage is essential to understanding why it happened so fast. Part 7. The trigger when house prices started falling. Everything we have discussed so far was the setup, the loaded gun, the rising tension, in a story that everyone involved was telling themselves was not going to end badly. Because it had not ended badly yet, and because too many people were making too much money for it to end badly. It ended badly. The American housing market peaked in the summer of 2006. Prices began to decline, at first slowly, a few percent in some markets, barely noticeable against the backdrop of the gains of the previous decade, then more rapidly, then catastrophically. The first visible casualties were in the subprime mortgage industry itself. In early 2007, several small subprime lenders began to report serious problems with their loan portfolios. Delinquency rates, the percentage of borrowers missing payments, were rising. Foreclosure rates were rising. The loans that had been made to NINJA borrowers and stated income borrowers and borrowers with adjustable rates that were about to reset, those loans were going bad. In February 2007, HSBC, the British bank, announced that it was taking a charge of $10.5 billion against losses in its American subprime mortgage portfolio. It was one of the first major public acknowledgements that the subprime market had serious problems. The markets largely shrugged. In April 2007, New Century Financial, one of the largest subprime lenders in the United States, filed for bankruptcy. It was one of the biggest originate-to-distribute operations, making loans and selling them as fast as it could. When the loans started going bad and it could no longer sell them, it collapsed almost immediately. Still, the markets largely shrugged. In June 2007, Bear Stearns, one of the major Wall Street investment banks, disclosed that two of its hedge funds, which had invested heavily in subprime mortgage securities, were in serious trouble. By July, those funds had lost essentially all of their value. Bear Stearns had to bail out one of the funds with a $3 billion loan. The other it allowed to collapse. Investors in the funds lost billions. This should have been a serious warning sign. Bear Stearns was one of the most sophisticated mortgage investors on Wall Street. Its hedge funds had been managed by experienced professionals with access to the best information available, and they had lost essentially everything. The products they had believed were safe, rated AAA by the major agencies, had proven to be worthless. But the full implications took months to propagate through a system that was invested financially and psychologically in believing that things were fine. Through the second half of 2007, conditions deteriorated gradually and then rapidly. The commercial paper market, where financial institutions borrowed short-term money to fund their longer-term holdings, began to freeze. Lenders became unwilling to roll over short-term loans to institutions that held mortgage-backed assets because they no longer trusted the valuations of those assets. The shadow banking system, which depended entirely on the continued ability to borrow short-term in the commercial paper market, began to suffocate. In August 2007, the European Central Bank made an emergency injection of 95 billion euros into the banking system, the largest such intervention since the September 11th attacks. The Bank of England did the same. The signals were unmistakable for anyone watching. The global financial system was in serious distress. In September 2007, a British bank called Northern Rock, which had become heavily dependent on wholesale funding rather than deposits, experienced the first bank run in the United Kingdom in 150 years. Queues of depositors formed outside branches across the country. The images of ordinary British people lining up to withdraw their savings from a high street bank made the financial crisis real to people who had been largely unaware of it. Northern Rock was subsequently nationalized by the British government. The year 2007 ended with the financial system deeply stressed, significant losses realized, and many more unrealized, and a growing awareness among sophisticated participants that the problems were much larger than had been publicly acknowledged. But the catastrophic event, the event that would make 2008 a year people would still be talking about decades later, was still ahead. Part 8. The the week that changed everything, September 2008. On Friday, the 12th of September 2008, Timothy Geithner, then president of the Federal Reserve Bank of New York, called the chief executives of the major Wall Street firms into a meeting at the New York Fed. The message was blunt. Lehman Brothers, one of the oldest and largest investment banks in America, was on the verge of collapse. The government was not going to bail it out. The industry needed to find a solution over the weekend, or Lehman would file for bankruptcy Monday morning. Lehman Brothers had been founded in 1850. It had survived the Civil War, 2 World Wars, the Great Depression, and dozens of recessions and financial crises over 158 years. In September 2008, it had approximately 25,000 employees and over $600 billion in assets, and it was going to cease to exist within 72 hours. The weekend negotiations were frantic. Barclays, the British bank, expressed interest in acquiring Lehman, but needed regulatory approval from the British Financial Services Authority, which declined to grant it on the required timeline. Bank of America, another potential acquirer, instead pivoted to acquire Merrill Lynch, another major investment bank that was also in serious trouble, in a deal announced that same weekend. On Sunday, the 14th of September, it became clear that no rescue was coming for Lehman. In the early hours of Monday, the 15th of September 2008, Lehman Brothers filed for Chapter 11 bankruptcy, the largest bankruptcy filing in American history. $600 billion in assets, 25,000 employees, 158 years gone. The decision not to save Lehman, and who made it and why, has been debated ever since. Henry Paulson, the Treasury Secretary, has maintained that he did not have the legal authority to provide the kind of support that would have been necessary without a private acquirer. Federal Reserve Chairman Ben Bernanke has said similar things. Others have argued that the political environment, the intense public anger at financial industry bailouts that was already building, made a Lehman rescue politically impossible. Others still have suggested that regulators did not fully understand how interconnected Lehman was with the rest of the financial system and genuinely underestimated the consequences of letting it fail. Whatever the reason, the consequences were immediate and catastrophic. Lehman had been a counterparty, a party on the other side of financial transactions, to hundreds of financial institutions around the world. It had borrowed money from money market funds, banks, and other financial institutions. It had entered into derivatives contracts, credit default swaps, interest rate swaps, currency swaps with banks and investors globally. When Lehman failed, all of these relationships suddenly became uncertain. Who was owed money? Who had exposure to Lehman through derivatives? How much was the exposure? Nobody knew for certain, and in the absence of certainty, the financial system's response was to stop trusting everyone. The money market fund industry, which had been considered essentially risk-free, was hit almost immediately. The Reserve Primary Fund, one of the oldest money market funds in the United States, held Lehman Brothers commercial paper. With Lehman bankrupt, that paper was worthless. On September 16th, one day after the Lehman bankruptcy, the Reserve Primary Fund announced that its net asset value had fallen below $1 per share. In the industry's terminology, it had broken the buck. Investors had been told money market funds were safe. Now, one of the most established was not. The reaction was a run. In the days following the Lehman bankruptcy, investors withdrew approximately $300 billion from money market funds. This was catastrophic because money market funds were a critical source of short-term funding for corporations and financial institutions across the economy. As they withdrew, they stopped lending. And as they stopped lending, the short-term funding markets that the entire financial system depended on began to seize. On September 16th, the same day the Reserve Primary Fund broke the buck, the Federal Reserve announced an $85 billion emergency loan to AIG, the American International Group. The world's largest insurance company, AIG had written credit default swaps, essentially insurance, on hundreds of billions of dollars of mortgage-backed securities. As those securities declined in value, AIG was required to post collateral against its swaps positions. It did not have the cash. It was going to default on its obligations. And unlike Lehman, which was a standalone investment bank, AIG was connected to virtually every major financial institution in the world through its insurance operations. Letting AIG fail would have immediately wiped out the capital positions of banks globally. The AIG bailout was the moment when the fiction that the crisis could be contained collapsed entirely. The largest insurance company in the world had been destroyed by exposure to products its own managers had not fully understood, and the US government was spending $85 billion of public money to save it. In the week following the Lehman bankruptcy, the financial system experienced a degree of stress that had not been seen since the Great Depression. The overnight lending rate between banks, the rate at which banks lent money to each other for one day, spiked to levels that suggested banks did not trust each other at all. Stock markets around the world fell sharply. Governments from Iceland to Australia scrambled to guarantee bank deposits and provide emergency liquidity. The LIBOR oil spread, a technical measure of stress in the banking system, reached levels that indicated near complete breakdown of trust in the interbank lending market. Henry Paulson, in the days following Lehman, would later describe calls with foreign finance ministers who were trying to understand what was happening to the global financial system. In his memoir, he described the feeling that the system might simply stop functioning, that the chain of trust and credit that underpins all economic activity might break in a way that could not be quickly repaired. But before the second half, let me go deeper on something that the crisis reveals about how financial systems actually work, because the mechanics of 2008 are not just history, they are a window into the logic of the system you are operating in today. Part 21. Why the stem was designed the way it was, and who it was designed for. The financial crisis of 2008 is sometimes described as a failure of greed, as if greed is a periodic natural disaster that strikes financial systems and then passes. This framing is comforting because it implies that greed can be addressed through moral improvement or better individual choices. It is also largely useless as an explanation. The better explanation is incentive structure. The mortgage originators, the investment banks, the rating agencies, the regulators, they were all responding rationally to the incentives they faced. The mortgage originator was paid per loan originated, not per loan repaid, so they made as many loans as possible, regardless of quality. The investment bank was paid per deal structured and distributed, so they structured and distributed as many deals as possible, regardless of the quality of the underlying assets. The rating agency was paid per rating given, so they gave ratings generously to maintain the business relationship with the issuer. None of these actors were necessarily making choices they knew to be wrong. Many genuinely believed the models. Many genuinely believed house prices would keep rising. Many genuinely believed the diversification of the securitized pools reduced risk to acceptable levels. The system produced bad outcomes not primarily because of malice, but because the incentives pointed systematically in the wrong direction. This distinction matters because it tells you something important about how to protect yourself from similar dynamics in the future. You cannot protect yourself from malice by assuming everyone is acting in good faith. You can protect yourself from misaligned incentives by understanding what those incentives are, by asking, in any financial transaction, how is the person on the other side of this being paid, and what behavior does that payment incentivize? The mortgage broker who calls you is paid a commission on origination. Their incentive is to close the deal, not to ensure the loan is right for you. The financial advisor who recommends a product is often paid a commission on the sale. Their incentive is to recommend products that pay commissions, not necessarily the best products for your situation. The fund that markets itself as providing superior returns is paid a percentage of assets and performance. Their incentive is to gather assets and retain them, not to underperform and see clients leave. Understanding the incentive is not paranoia, it is clarity, and the clarity it provides is one of the most useful things you can take away from the story of 2008. A story about what happens when a system's incentives and its stated purpose become comprehensively misaligned. Part 9. The Global Contagion, How It Crossed the Atlantic. The story of 2008 is often told as an American story, American housing bubble, American subprime loans, American investment banks, American regulatory failure. And while America is where the crisis originated and where its institutional epicenter was, the damage was genuinely global. Not because the rest of the world was passive victim, but because the rest of the world had actively bought into the American mortgage machine. European banks, German banks, French banks, British banks, Swiss banks, Belgian banks had purchased enormous quantities of American mortgage-backed securities and CDOs. They bought them because they offered higher yields than European government bonds. They bought them because they were rated AAA by the major agencies. They bought them because their own internal risk models, built on the same flawed assumptions as the American models, suggested they were safe. And they bought them through the same shadow banking structures, structured investment variables, special purpose variables that kept the exposure off their balance sheets and away from regulatory scrutiny. IKB Deutsche Industrie Bank, a mid-sized German lender, was one of the first European casualties. In July 2007, it revealed losses from its exposure to American subprime mortgages and had to be rescued by a consortium of German banks. IKB had been lending to German small and medium-sized businesses. It had ended up holding exposure to ninja loans from Florida. The chain of securitization connecting those two things had been invisible to almost everyone involved. Iceland provides perhaps the most dramatic example of how far the contagion reached. Iceland is a small island nation of approximately 300,000 people. In the years leading up to 2008, its banking system had expanded to roughly 10 Icelandic economy. Its three major banks, Glitnir, Landsbanki, and Kaupthing, had borrowed heavily in international wholesale markets and invested in assets across Europe and beyond, including significant exposure to structured credit products. When the wholesale funding markets froze following the Lehman bankruptcy, the Icelandic banks could not refinance their short-term borrowing. All three collapsed within a week of the Lehman bankruptcy. The Icelandic government was forced into an IMF rescue package. The Icelandic krona lost half its value. Ordinary Icelanders saw their savings devastated and their economy contract by 10% in a single year. Ireland had a different route to the same destination. Irish banks had borrowed heavily in international markets and used the money to fund an extraordinary domestic property bubble. Irish house prices had roughly tripled between 1995 and 2007. When the bubble burst and Irish property values collapsed, the losses at the Irish banks were so large relative to the Irish economy that the Irish government's decision to guarantee all bank liabilities, taken in a single night in September 2008, effectively transferred the banking system's losses onto the Irish state. Ireland subsequently required an international bailout. Its economy contracted severely. Unemployment rose above 14%. A generation of young Irish people emigrated. In Spain, a similar dynamic played out. Spanish banks had funded a construction and property boom using wholesale borrowing from European financial markets. When the boom ended and Spanish property values fell sharply, Spanish banks faced enormous losses. The Spanish government required a €100 billion European rescue package in 2012. Spanish unemployment reached 27%, nearly half among young people. The common thread across all of these national stories is the same. Financial institutions had borrowed cheap short-term money from global wholesale markets and used it to fund longer-term, riskier assets, often connected to property, directly or through securitized products. When the wholesale funding markets froze in September 2008, institutions that depended on them could not refinance, could not meet their obligations, and collapsed. The globalization of finance, the free movement of capital across borders that had been celebrated as a feature of the modern financial system, turned out to also mean the free movement of contagion. A problem in American housing could destroy an Icelandic bank, cause a property crash in Ireland, and generate a sovereign debt crisis in Spain. Not because those economies were directly connected to American housing, but because they were all connected to the same global funding markets that froze when American housing collapsed. PAT 10. The panic what happened behind closed doors. The public story of the financial crisis, the headlines, the bankruptcy filings, the stock market declines, was dramatic enough. The private story, reconstructed from memoirs, congressional testimony, and subsequent reporting, was more dramatic still. In the days following the Lehman bankruptcy, the senior officials managing the crisis, Paulson at the Treasury, Bernanke at the Federal Reserve, Geithner at the New York Fed, were working around the clock with diminishing certainty about what was happening and genuine fear about what might happen next. The financial system they were responsible for was failing in real time. The models and frameworks they had used to understand it were proving inadequate, and the tools available to them, the legal authorities, the institutional arrangements, had not been designed for a crisis of this magnitude. Paulson, by his own account, was making calls to foreign finance ministers who were terrified. He was receiving calls from bank chief executives who were telling him their institutions might not survive the week. He was working within a legal framework that had been designed for a different era and that imposed real constraints on what the government could do to stabilize the system. And he was doing all of this while trying to manage a political environment that was deeply hostile to any action that could be characterized as a bailout of the banks that had caused the crisis. The moment that most vividly captures the desperation of the period comes from the negotiations over the troubled asset relief program, the $700 billion rescue package that Paulson brought to Congress in the days after Lehman. Nancy Pelosi, then Speaker of the House, has described Paulson literally going down on one knee in the corridor of the Capitol and begging her not to blow up the deal with public statements that would make it politically impossible. Whether the details of that moment are exactly as described, it's essential truth that the most powerful economic officials in the world We're genuinely frightened and genuinely uncertain. Captures something real about the period. The Federal Reserve in those weeks was making decisions with uncertain legal authority, under extreme time pressure, with incomplete information about the scale of the problem and imperfect tools for addressing it. Ben Bernanke, a scholar of the Great Depression who had spent his academic career studying how policy failures in the 1930s had turned a financial crisis into an economic catastrophe, found himself in the position of trying to prevent a repeat. His assessment, shared by most economists who have examined the period, is that the aggressive interventions of September and October 2008 were essential in preventing an outcome significantly worse than what occurred. But the interventions required decisions that would have been politically impossible a month earlier and that generated enormous public anger afterward. Guaranteeing money market funds, providing emergency lending to non-bank financial institutions, injecting capital directly into the banking system, purchasing assets that had never before been purchased by the central bank. Each step moved further from conventional central banking practice and further into territory where legal authority was uncertain and democratic accountability was minimal. The feeling in those days, reported by virtually everyone involved, was that the financial system was genuinely weeks, perhaps days, from a breakdown that would affect ordinary people in ways that went far beyond falling stock prices and declining house values. Cash machines not working, businesses unable to meet payroll, trade finance drying up, and global trade slowing. These were not hypothetical risks being discussed in theoretical terms. They were scenarios being actively modeled by officials who thought they were plausible. A quick note before we continue: I am not a financial advisor. This is not financial advice. Everything tonight is educational. Please do your own research before making any financial decisions. Part 11. The Rescue, the TARP, and the Socialization of Losses. On October 3rd, 2008, President George W. Bush signed the Emergency Economic Stabilization Act, the legislation authorizing the Troubled Asset Relief Program, or TARP, into law. The program authorized the Treasury to spend up to $700 billion to stabilize the financial system. It was the largest financial intervention in American history. The original conception of TARP was to purchase troubled assets, the mortgage-backed securities and CDOs that were sitting on bank balance sheets with uncertain values, preventing banks from understanding their true financial position. If the government bought these assets at some price, banks would know where they stood, confidence would return, and lending would resume. This plan was abandoned almost immediately after the legislation passed. The problem was practical. There was no obvious fair price for assets that were genuinely difficult to value, and that the market had essentially stopped trading. Buying them too cheaply would crystallize losses and potentially worsen the bank's capital positions. Buying them too expensively would amount to an obvious subsidy to the banks at taxpayer expense. Instead, Paulson pivoted to using TARP capital to directly inject equity into the major banks. On October 13th, Paulson called the chief executives of the 9 largest American banks to a meeting at the Treasury and told them they were each going to receive capital injections ranging from $25 billion for the largest banks to smaller amounts for others. The banks were not given a choice. The government was becoming a shareholder, whether the banks wanted it to or not. This move stabilized the major banks. It provided them with capital cushions that made their failure much less likely. It partially restored confidence that the financial system would not collapse, and it generated immediate and enduring public fury. The fury had a simple logic. The banks had created the crisis. Their reckless lending, their opaque products, their extreme leverage, these were the causes of the disaster. The people who suffered the consequences, the workers who lost their jobs, the homeowners who lost their houses, the retirees who watched their pension funds decline, had not made the decisions that caused the damage. And yet the response was to spend $700 billion of public money stabilizing the institutions that had caused it. The justification was equally simple. If the major banks failed, the damage to ordinary people would be far worse than anything that could be addressed through the TARP intervention. The financial system is the infrastructure of the economy. When it fails, economic activity stops in ways that affect everyone, including especially people who had no involvement in the decisions that caused the crisis. The choice was not between saving the banks and punishing them. It was between saving the banks and the Great Depression. Both positions are defensible. The genuine tragedy of the situation, which generated anger that has not fully dissipated 15 years later, is that the system was structured in a way that made both positions simultaneously true. The banks caused a crisis that could only be resolved by saving the banks at public expense. There was no good outcome available, only choices between different configurations of bad outcomes. P-8012, who paid and who did not, the reckoning that never came. Here is the fact about the aftermath of the 2008 financial crisis that generates more sustained anger than any other, despite the scale of the damage, despite the complexity and obvious recklessness of the products involved, despite the misaligned incentives, the ratings failures, the regulatory capture, and the leveraged gambling with depositors' money. There was essentially no criminal accountability for the individuals responsible. One person, one significant person, went to prison in connection with the financial crisis. Karim Serageldin, a trader at Credit Suisse, was convicted in 2013 of conspiracy to falsify books and records in connection with the concealment of losses in a mortgage bond portfolio. He was sentenced to 30 months in prison. One person for the largest financial catastrophe since the Great Depression. The Department of Justice pursued civil cases against financial institutions, most notably the large settlements reached with Bank of America, JP Morgan Chase, Citigroup, and others, totaling tens of billions of dollars in aggregate. These settlements required the banks to pay significant sums but did not require any admission of wrongdoing and imposed no penalties on the individuals whose decisions had caused the damage. The banks paid, their shareholders paid, the executives who had made the decisions retired with their wealth intact. Why? The explanations are contested and multiple. One explanation is legal. Proving criminal intent in complex financial transactions is genuinely difficult. Many of the decisions that caused the crisis were defensible under the standards of the time, even if they appear reckless in retrospect. The complexity of the products made it difficult to establish that specific individuals knew they were committing fraud rather than making optimistic but good faith assessments of risk. A second explanation is institutional. The Department of Justice was concerned that aggressive prosecution of major financial institutions might destabilize them at a time when stability was still fragile. This concern, sometimes called too big to jail, led to a preference for civil settlements over criminal prosecution that would have created more legal uncertainty. A third explanation is more structural. The financial industry is the most politically powerful industry in the United States. It is the largest source of political donations. It employs more lobbyists than any other sector. The revolving door between Wall Street and Washington regulatory agencies is well documented. The political system that would have had to drive aggressive prosecution of the financial industry was deeply embedded in relationships with that industry. Whatever the explanation, and probably all three contained truths, the outcome was the same. The executives who had built the leverage, structured the CDOs, rated the products, and sold them to investors who did not understand what they were buying retired wealthy. Some returned to prominent positions in finance. The workers who lost their jobs and the homeowners who lost their houses did not retire wealthy. This outcome is not just a question of fairness, though it is obviously a question of fairness. It is a question of incentives for the future. If the people who make decisions that cause massive harm face no personal consequences for those decisions, the incentive structure for future decision-making is unchanged. The lesson learned from 2008 for the individuals involved was not that reckless behavior has consequences. It was that reckless behavior at sufficient scale is insulated from personal consequence because the system cannot afford to let it fail. Which, draw your own conclusions. Part 13. The Great Recession, the damage to real lives. The financial crisis of 2008 and the Great Recession that followed it are described in economic terms: GDP growth rates, unemployment percentages, credit spreads, bank capital ratios. These numbers are necessary for understanding the scale of what happened. They are not sufficient for understanding what it meant. In the United States, the recession that followed the financial crisis was the deepest since the Great Depression. The economy lost approximately 8.5 million jobs between December 2007 and February 2010. Unemployment reached 10% in October 2009, the highest rate in 26 years. The unemployment rate among Black Americans reached nearly 17%. Among young people without college degrees, it was higher still. Approximately 4 million American families lost their homes to foreclosure between 2007 and 2012. Not 4 million financial transactions, 4 million families, adults, children, elderly people, who watched their homes taken by banks, who moved into apartments or in with relatives or into hotels, who lost the stability and security that a home represents. In some neighborhoods, particularly in the inland areas of California and Nevada, in Arizona, in Florida, the physical landscape was transformed by vacant houses, overgrown lawns, and for sale signs stretching as far as the eye could see. The crisis disproportionately affected people who had been most aggressively targeted by predatory lending. Low-income communities and communities of color had been the primary targets of subprime mortgage marketing, not because their creditworthiness was lower, but because they were underserved by the traditional banking system and therefore more susceptible to high-pressure sales of products that were structurally designed to fail. When the loans failed and foreclosures came, the same communities bore the largest share of the damage. The damage to retirement savings was severe and lasting. The stock market fell approximately 57% from peak to trough between October 2007 and March 2009. For someone who retired in early 2009, who had been counting on their 401k or pension fund to support them, the timing was catastrophic. The sequence of returns risk we discussed in a previous video was not theoretical for this cohort. It was real, immediate, and in many cases financially devastating. For young people entering the labor market between 2008 and 2012, the scarring effects have been studied extensively and are well documented. People who graduate into recessions earn less than they would have in normal times, and this wage penalty persists for years or decades. The cohort that entered the workforce during and immediately after the Great Recession has earned less over their careers than the cohort that entered before it, even after the economy recovered. The damage to lifetime earnings from a bad entry point is not quickly reversed. In Europe, the damage was similarly severe and in some cases worse. Spain's unemployment rate reached 27%. Greece, which required multiple international bailout packages, saw its economy contract by about a quarter between 2008 and 2013. An entire generation of young Greeks and Spaniards emigrated to Germany, to the UK, to Australia, because there were simply no jobs at home. Portugal, Ireland, and Cyprus all required international assistance. The political consequences, the rise of populist parties on both left and right, the weakening of mainstream political parties, the growth of Euroscepticism, are still playing out. The human cost of the financial crisis is not captured in interest rate spreads or credit default swap pricing. It is captured in the 10 million Americans who lost their homes. In the Southern European generation that lost the first decade of their working lives, in the Icelandic families who saw their savings wiped out, in the British workers who spent years on 0 hours contracts because employers remained too uncertain about the future to commit to permanent employment. Part 14. The reforms, Dodd-Frank, and what actually changed. In the aftermath of the crisis, there was broad political consensus that the regulatory framework that had failed so comprehensively needed reform. The question was what reform would look like, how far it would go, and how durable it would be. In the United States, the primary legislative response was the Dodd-Frank Wall Street Reform and Consumer Protection Act, which signed into law by President Obama in July 2010. It was the most comprehensive financial regulatory reform since the Glass-Steagall Act of 1933, enacted in the aftermath of the Great Depression. And like that legislation, it was enormously controversial, enormously complex, and immediately subject to intense lobbying effort to limit its scope and effectiveness. Dodd-Frank addressed several of the structural failures that had contributed to the crisis. It established the Financial Stability Oversight Council, a body charged with identifying systemic risks to the financial system before they materialized. It created the Consumer Financial Protection Bureau, an agency specifically focused on protecting consumers from predatory financial products of the kind that had proliferated in the mortgage market. It imposed new capital requirements on large banks, reducing the extreme leverage ratios that had made the banking system so fragile. It required greater transparency in the derivatives markets, moving many derivatives onto exchanges where prices would be publicly visible and clearing through central counterparties that could manage the risk of a counterparty failure. The Volcker Rule, one of the most debated provisions, attempted to prevent banks from engaging in proprietary trading, making bets with their own capital for their own profit, rather than for clients. The principle was that deposit-taking institutions should not be gambling with depositor money on market positions. In practice, the definition of proprietary trading was intensely contested. The rule was enormously complex, and its effective enforcement has been disputed by its supporters and opponents ever since. What Dodd-Frank did not do was equally significant. It did not reinstate the full separation of commercial and investment banking that Glass-Steagall had imposed and that had been repealed in 1999. It did not break up the largest banks, the too big to fail institutions whose potential failure was still implicitly guaranteed by the government. It did not impose meaningful personal liability on financial executives for decisions that harmed their institutions. It did not address the fundamental conflict of interest in the ratings agency business model. And its effectiveness was progressively diluted through subsequent regulatory rulemaking and, under the Trump administration, partial legislative rollback through the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018. In Europe, regulatory reform took somewhat different forms. Basel III capital requirements, stress testing of major banks, the establishment of the European Stability Mechanism, and the banking union in the Eurozone. These reforms increased the capital buffers held by European banks and improved the frameworks for managing failing banks. Whether they are sufficient to prevent a repeat of 2008 is genuinely contested among economists. The honest assessment is that the financial system in 2024 is meaningfully safer than it was in 2007. Major banks hold more capital. Leverage ratios have been reduced. Derivatives markets are more transparent. Regulators are more attuned to systemic risk. But the fundamental dynamics, financial innovation outpacing regulation, the concentration of risk in large institutions, the misalignment of incentives and compensation structures, the complexity of products that even sophisticated investors struggle to understand, these have not been resolved. They have been moderated. Part 15 What 2008 teaches you the lessons for an ordinary investor. We have spent most of tonight in history. Now let me bring it forward to what the 2008 financial crisis actually means for someone managing their own finances today. The first lesson is about complexity. The products at the center of the 2008 crisis, CDOs, synthetic CDOs, CDO squared, were so complex that the people selling them and the people rating them did not fully understand them. This is not just a historical curiosity, it is a durable principle about financial products in general. Complexity in a financial product almost always serves the interests of the seller more than the buyer. The fee structures are less visible, the risks are harder to assess, the comparison to alternatives is more difficult. When you encounter a financial product you do not fully understand, an investment product with a complicated structure, a loan with variable rates and multiple conditions, an insurance product with extensive exclusions, the complexity is a signal to slow down, to ask more questions, to consider whether a simpler alternative exists. The products that most reliably produce good outcomes for ordinary investors are also the simplest: low-cost index funds, standard savings accounts for short-term money. The simplicity is not a failure of sophistication, it is a feature. The second lesson is about incentives. The mortgage originators made loans they knew were unlikely to be repaid because they were paid per loan originated, not per loan repaid. The investment banks packaged these loans into products they knew were risky because they were paid per deal structured. The rating agencies rated these products as safe because they were paid by the issuers. In each case, the actors were responding rationally to the incentives they faced, which were systematically misaligned with good outcomes for the end investors. This dynamic incentive misalignment between financial intermediaries and the people they serve has not gone away. It is structural. Whenever you engage with the financial system, the useful question is, how is this person being paid And what behavior does that incentive drive? An advisor paid by commission has different incentives from an advisor paid by fee. A fund that earns more from higher cost products has different incentives from a passive index provider. The third lesson is about leverage. The fragility of the banking system in 2008, the fact that institutions could become insolvent from a 3% decline in asset values, was the direct consequence of extreme leverage. For ordinary investors, the lesson is straightforward. Borrowed money amplifies both gains and losses. In good times, leverage looks like genius. In bad times, it produces catastrophic losses. Long-term wealth building does not require leverage, and the reduction in expected loss that comes from avoiding it is worth more than the increase in expected gain that leverage theoretically provides. The fourth lesson is about the correlation of risks. The diversification argument for mortgage-backed securities was based on the idea that individual mortgage defaults were not correlated. If one person defaulted, it did not make it more likely others would default. This was true in normal times. In a nationwide housing decline, it was catastrophically false. All the mortgages declined together, eliminating the diversification benefit entirely at exactly the moment it was most needed. For investors, this means understanding that in genuine crises, the situations where diversification matters most, correlations between different risk assets tend to rise. Stocks and corporate bonds often fall together. Different equity markets around the world often fall together. The diversification that protects you during normal market fluctuations may provide less protection during a genuine systemic crisis. This is one reason why high-quality government bonds, whose behavior during crisis has historically been more genuinely decorrelated from equities, are valuable as a portfolio component despite their lower expected returns. The fifth lesson is about the limits of models. The financial models used to price and assess the risk of mortgage-backed products were wrong in ways that were predictable in retrospect, and that some analysts predicted in real time. The models used historical data that did not include a nationwide housing decline. They assumed correlations that held in normal times and failed in extreme times. They were built by intelligent people who genuinely believed in them and who had enormous financial incentives to believe in them. When any financial institution, a bank, a rating agency, a fund manager tells you that their models show something is safe, it is worth asking what assumptions those models make and what happens if those assumptions are wrong. Models are not reality. They are simplified representations of reality that work under certain conditions and fail under others. The question is always, what are the conditions under which this model breaks down? And what does all of this tell you about the financial system today? The honest answer is that the system is more regulated and better capitalized than it was in 2007. The most extreme forms of the products that caused the crisis have largely disappeared from the market. Banks are required to hold more capital. Stress tests are conducted regularly. Regulators are more focused on systemic risk. And the system still has large banks that are implicitly guaranteed by governments because their failure would be too damaging. It still has incentive structures that reward short-term risk-taking over long-term prudence. It still generates enormous complexity that serves the interests of intermediaries more than end investors. It still operates faster than regulation can follow. And it will, at some point in the future, produce another crisis, because crises are not accidents. They are the periodic consequence of a financial system whose participants have individual incentives that are not fully aligned with collective stability. This is not a counsel of despair, it is a counsel of clear-eyed realism. The financial system is a tool. Like any powerful tool, it can be used well or poorly. Understanding how it works, including its failure modes, its incentive structures, and its historical patterns, makes you better able to use it for your own purposes while protecting yourself from its worst dynamics, which is ultimately what all of this has been about. Part 16, the people who saw it coming and why nobody listened. One of the most instructive and most infuriating aspects of the 2008 financial crisis is that it was not entirely unpredicted. A small number of analysts, economists, and investors saw the danger clearly, some years before the crash, and either could not make themselves heard or chose to bet against the consensus and profit from the collapse. Nouriel Roubini, an economist at New York University who had earned the nickname Dr. Doom for his pessimistic forecasts, warned in 2006 at an International Monetary Fund meeting that the United States was likely to face a once-in-a-lifetime housing bust, an oil shock, sharply declining consumer confidence, and a deep recession. His presentation was met with polite skepticism. IMF economists noted that his track record of pessimism had produced many false alarms. The warning was noted and largely ignored. Robert Shiller, the Yale economist and Nobel Prize winner, who had developed indices for measuring housing prices, had been publicly warning about the housing bubble since at least 2003. His data showed clearly that house prices had risen to levels that were historically anomalous relative to incomes and rents. The market's response was essentially to argue that this time was different, that demographic trends, financial innovation, and the structural transformation of the economy justified permanently higher price-to-income ratios. Within the financial industry, there were analysts at the major banks whose internal research identified the deteriorating quality of mortgage underwriting and the structural problems with CDO ratings models. Some of these analysts were told to modify their reports, some were reassigned. The pressure to maintain a positive view of products that were generating enormous revenue was intense, and in some documented cases overrode the professional judgment of people whose job was to assess risk honestly. And then there were the investors who did not merely warn about the coming crisis, but actively bet on it. Michael Burry, a one-eyed physician turned hedge fund manager who had taught himself finance by reading everything he could find, spent 2005 and 2006 painstakingly going through the actual mortgage pools underlying MBS and CDOs, loan by loan, looking at the actual underwriting standards of the actual borrowers. What he found convinced him that the products were much riskier than the ratings suggested, and he began purchasing credit default swaps, insurance against the failure of mortgage bonds, in large quantities. Burry's insight required genuine intellectual work and the courage to hold a position that was losing money for years as the market continued to rise. His investors demanded he liquidate. He refused. In 2007, as the mortgage market began to fail, his positions generated enormous profits. His fund made approximately $700 million from the trade. John Paulson, a relatively obscure hedge fund manager at the time, made a similar bet and made even more money. His fund generated approximately $15 billion in profits from bets against the mortgage market in 2007. The stories of these investors, told most vividly in Michael Lewis's book The Big Short, raise a question that is more than just interesting. If these people could see what was coming, why couldn't the system? Part of the answer is incentive. The people making money from the mortgage machine, the originators, the investment banks, the rating agencies, had powerful financial incentives not to see the problem. Part of the answer is cognitive. The market had risen for so long and so consistently that the assumption of continued rising became embedded in models, in professional culture, and in the individual psychology of practitioners who had spent their careers in an environment where housing always went up. And part of the answer is institutional. Financial institutions are organizations, and organizations have cultures, hierarchies, and political dynamics that shape what information gets heard and what gets suppressed. An analyst who warned loudly and repeatedly that the firm's most profitable product line was built on a foundation of bad loans was not going to be promoted. An executive who pushed back on leverage ratios that were generating record returns was not going to be celebrated. The institutional environment actively filtered out the information that would have been most useful. This dynamic, the systematic suppression of inconvenient information within institutions that have strong financial interests in not hearing it, is not unique to finance in 2007. It is a recurring feature of organizational behavior in environments where short-term profitability and long-term risk are in tension. And it is one of the reasons why the same patterns, bubbles, leverage, complexity, misaligned incentives tend to recur in financial markets across generations. Part 17. The housing crisis as a human story. The people behind the numbers. I want to spend some time on the human dimension of the foreclosure crisis specifically, because it is the piece of the 2008 story that gets least attention in the technical accounts and that matters most for understanding what financial crises actually cost. Between 2007 and 2012, approximately 4 million American households lost their homes to foreclosure. Another 8 to 10 million were at some point seriously delinquent on their mortgages or in some stage of foreclosure proceedings. This is not a statistic. It is tens of millions of people navigating one of the most stressful experiences available in modern life, the loss of their home, often after months of uncertainty, often while also dealing with unemployment, declining savings, and family strain. The foreclosure process in the United States is not quick or clean. It involves months of missed payments, mounting fees and penalties, letters from servicers who themselves were overwhelmed and often poorly organized, legal proceedings, and ultimately the physical departure from a home with all of the logistical, financial, and emotional complexity that involves. The research on the health consequences of foreclosure is extensive and consistent. People who lose their homes to foreclosure experience elevated rates of depression, anxiety, and physical health problems. Children in families that experience foreclosure show declines in academic performance. The stress of housing instability affects every aspect of daily functioning. In the hardest hit communities, the suburbs of Las Vegas, the inland valleys of California, the outer suburbs of Miami, the physical landscape reflected the human damage. Entire subdivisions of identical homes built during the boom to house the wave of buyers who could now no longer afford them sat vacant, pools turned green, lawns died, vandals stripped copper wiring and appliances from empty houses. The value of the remaining occupied homes fell further as the neighborhood deteriorated, trapping the people who remained in properties worth less than their mortgages, a condition called being underwater, unable to sell, unable to refinance, and watching their equity evaporate. The cruelty of the foreclosure crisis was not only that people lost their homes, it was that many of them had been sold those homes through products that were designed to be unaffordable in the medium term. The subprime mortgage with the 2-year teaser rate was not a neutral product offered to people who might or might not be able to afford it. It was a product marketed aggressively to people in communities that had been underserved by traditional banking, by salespeople who were paid per loan closed, regardless of whether the loan would ultimately be repaid. The people who signed these mortgages were not stupid. They were told by their mortgage brokers that they could refinance before the rate reset. They were told by real estate agents that the house would be worth more in 2 years than they were paying now. They were told by the broader culture that homeownership was safe and that house prices always went up. All of these claims were false. The information environment in which they made their decisions was systematically distorted by people with financial interests in them making those decisions. And when things went wrong, when the rate reset, when the value fell, when refinancing was impossible because values had declined below the loan balance, they bore the consequences while the people who had built and sold the products walked away. Part 18: The Political Consequences. How 2008 changed everything. The financial crisis and the Great Recession that followed it had political consequences that are still playing out. Understanding them is part of understanding what 2008 actually meant. The most immediate political consequence was the bank bailouts themselves, the use of public money to stabilize financial institutions that had caused the crisis, and the subsequent failure to meaningfully hold individuals responsible created a deep and durable public anger that transcended conventional political divisions. The Tea Party movement on the American right and the Occupy Wall Street movement on the left were both, in different ways, expressions of the same fury at the apparent immunity of financial elites from the consequences of their own failures. This anger did not dissipate as the economy recovered. It transformed. It became a generalized distrust of established institutions, banks, governments, regulatory agencies, media organizations that had failed to prevent the crisis or to hold its architects accountable. This distrust contributed to the populist political movements that subsequently transformed politics across the developed world. The election of Donald Trump in 2016 was driven by many factors, but the accumulated grievances of communities devastated by the Great Recession and the perception of elite immunity from its consequences were among them. The rise of populist parties across Europe, in France, Italy, Germany, Hungary, Poland, drew on similar dynamics. The crisis also had specific economic policy consequences that shaped the decade that followed. The response to the financial crisis, the combination of government fiscal stimulus and unprecedented central bank intervention, was genuinely successful in preventing the recession from becoming a depression. But the scale of the intervention created political and institutional constraints on subsequent economic policy. The political backlash against government spending led to premature fiscal austerity in Europe that deepened and prolonged the recession, particularly in the Eurozone. The central bank interventions, quantitative easing, near zero interest rates that were maintained for years after the acute phase of the crisis contributed to rising asset prices that disproportionately benefited people who already owned assets, widening wealth inequality in ways that had their own political consequences. The housing crisis specifically had lasting demographic consequences. The generation that would normally have been buying first homes between 2008 and 2015, the millennials, instead delayed home ownership, partly because of economic uncertainty and damaged credit, partly because of tight lending standards, and partly because the cultural memory of watching parents lose their homes made property seem less obviously safe than it had to previous generations. The resulting delayed family formation, delayed household creation, and sustained demand for rental housing had significant effects on housing markets that persisted for years. Part 19. The Crisis in Context: How 2008 fits into financial history. The financial crisis of 2008 was genuinely extraordinary in scale and in the speed of its global propagation, but it was not without precedent. Financial crises, bubbles, crashes, banking collapses are a recurring feature of market economies, and understanding 2008 in the context of this history is useful. Carmen Reinhardt and Kenneth Rogoff, two economists who studied centuries of financial crisis in their book This Time is Different, found that the pattern of 2008 was remarkably similar to previous financial crises across history and geography. A period of financial innovation, a credit expansion that outpaced the economy's productive capacity, rising asset prices that seemed to justify the expansion, a peak, a crash, a period of deleveraging and economic contraction, a recovery that was slower and more painful than the boom that preceded it. The book's title, This Time is Different, refers to the argument that participants in financial bubbles typically make to explain why the historical pattern does not apply to their situation. The specific reasons vary. In 2007, it was that financial innovation had eliminated the risk from mortgage lending by distributing it globally. In the dot-com bubble of the 1990s, it was that the internet had changed the economics of business in ways that made traditional valuation irrelevant. In the Japanese property bubble of the 1980s, it was that Japanese land was uniquely scarce and uniquely valuable. In the Dutch tulip mania of the 17th century, it was, apparently, that some tulips were genuinely exceptional. The argument that this time is different has always eventually been wrong. This pattern, the recurrence of financial crises, despite their obvious costs and despite the best efforts of regulators and policymakers to prevent them, raises a difficult question. Is this inevitable? Is financial instability simply a permanent feature of market economies that must be periodically managed rather than prevented? Most economists who have studied the question believe the answer is yes, in the sense that some degree of financial instability is inherent to systems that allow credit creation, leverage, and financial innovation. The specific mechanisms change. The products involved in the next crisis will likely be different from the products involved in 2008. But the underlying dynamics, credit expansion, rising asset prices, leverage, incentive misalignment, eventual correction, are embedded in the structure of modern financial systems. The practical implication for ordinary investors is not despair but preparedness. Financial crisis will occur again. The timing is uncertain. The specific mechanism is uncertain. But the general pattern of credit expansion leading to asset price inflation leading to correction is not. An investor who understands this, who maintains adequate diversification, who avoids leverage, who keeps a meaningful cash buffer, who is not entirely dependent on asset prices remaining high to maintain their financial position, is far better placed to survive the next crisis than one who has not thought about it. You cannot predict when the next crisis will come. You can structure your financial life to be resilient when it does. Part 20. The Lasting Lessons. A framework for navigating an imperfect system. Let me close tonight by bringing everything together into a framework, a way of thinking about the financial system that is informed by what 2008 revealed about how it actually works. The financial system is not your friend and it is not your enemy. It is a tool enormously powerful, enormously useful, and in many ways genuinely aligned with your interests when used correctly. The stock market allows you to participate in the growth of the global economy. Mortgages allow people to own homes they could not otherwise afford. Insurance allows people to protect against risks they could not otherwise survive. Credit allows investment and consumption that creates economic value. These are genuine benefits. But the financial system is also populated by institutions and individuals whose incentives do not perfectly align with yours, whose products are sometimes designed to extract value rather than create it, whose complexity sometimes serves to obscure rather than to illuminate, whose risk assessments sometimes reflect what they want to be true rather than what is actually true. Navigating this system well does not require paranoia. It requires calibrated skepticism, a default of healthy questioning about the incentives behind any financial product or recommendation, combined with the willingness to use the system's genuine benefits when they are clearly on offer. The principles that protect you are not complicated. Understand what you own. If you cannot explain a financial product to someone else clearly, you do not understand it well enough to own it. Low-cost, simple products, index funds, straightforward insurance, standard savings accounts are almost always better than complex alternatives. The complexity in financial products almost always benefits the seller more than the buyer. Know who is paying your advisor and how. A financial intermediary whose compensation depends on what you buy has incentives that are not fully aligned with your interests. This does not make them dishonest, but it means you cannot simply trust their recommendations as if they were fully independent of those incentives. Understanding the compensation structure is basic due diligence. Avoid leverage. Not all leverage in all circumstances for all people, but as a default posture for long-term wealth building, the risk reduction from avoiding borrowed money is worth more than the return amplification it theoretically provides. The people who were wiped out in 2008 were almost always people who were leveraged. Maintain genuine diversification. Not the illusion of diversification from owning multiple products that are actually exposed to the same risks. Genuine diversification across asset classes, geographies, and types of risk. And maintain enough liquidity, enough cash and short-term assets that you do not have to sell long-term investments at the worst possible time because a short-term emergency demands it. And understand that financial crises are a permanent feature of the financial landscape. The next one will come. It will look different from the last one. It will be produced by a different mechanism, involve different products, be amplified by different technologies. But the underlying pattern, credit expansion, leverage, asset price, inflation, eventual correction, will be recognizable. The investor who survives and eventually prospers through financial crises is not the one who predicted them correctly or timed their exposure perfectly. It is the one who was structured well enough to not be destroyed by them, who did not have to sell at the bottom, who maintained their contributions through the downturn, who had enough cash not to panic, who had enough diversification not to be catastrophically concentrated in whatever asset class the crisis was centered on. Structure, resilience, patience. These are not exciting investment strategies, but 2008 showed very clearly what happens when excitement replaces prudence. The bill was paid not by the people who built the exciting products, but by the millions of ordinary people who had the misfortune to be on the wrong side of the incentive structures those products created. Understanding that, really understanding it, not just intellectually, but viscerally, is one of the most valuable things you can take from the story of 2008. Part 22. The short sellers, what betting against the market reveals. There is a final dimension of the 2008 story that deserves its own section because it reveals something important about how financial markets work and what it means when a small number of people can see clearly what the majority cannot. Short selling is the practice of profiting from the decline in the price of an asset. When you sell an asset short, you are borrowing it, selling it at the current price, and hoping to buy it back later at a lower price. The difference is your profit. Short sellers are often vilified during market declines, accused of causing the very falls they are profiting from. In reality, short sellers perform an important function in financial markets. They provide a mechanism through which skeptical views can be expressed, through which analysts who believe an asset is overvalued can act on that belief and profit if they are right. The people who shorted the mortgage market before 2008, Michael Burry, John Paulson, and a handful of others, were not causing the crash. The crash was caused by the fundamental unsoundness of the underlying assets. The short sellers were simply the first to recognize and act on that unsoundness. And in doing so, they were providing price signals that should, in theory, have been informative to the broader market. The fact that their signals were largely ignored, that the market continued to price mortgage-backed securities as if they were safe, even as Burry and others were aggressively purchasing credit default swaps on them, is itself revealing. It shows how powerful the combination of financial incentives and institutional inertia can be in suppressing inconvenient information. The mechanism through which short sellers influence markets is through price. When you sell something short, you are effectively adding supply, which should at the margin push prices down. But in the mortgage-backed securities market of 2007, the short sellers were not actually selling the securities themselves. They were buying credit default swaps, insurance contracts that paid out if the securities defaulted. The sellers of those credit default swaps, primarily AIG and the major investment banks, were taking the other side of the trade, effectively betting that the securities would not default, which means that for every short seller who correctly identified the problem, there was a counterparty, AIG, Goldman Sachs, Deutsche Bank, others, who was on the wrong side. And because the counterparties were large, well-capitalized institutions whose AAA credit ratings allowed them to post minimal collateral on these trades, they were able to accumulate enormous exposure before the scale of the problem became visible. When the crisis hit and the securities defaulted, those counterparties faced catastrophic losses. AIG alone had written approximately $500 billion of credit protection, essentially promising to absorb the losses of the holders of mortgage-backed securities if they defaulted. When they did default, AIG did not have the money to pay its claims. The government's $85 billion emergency rescue of AIG was not primarily about saving AIG. It was about preventing the cascade of losses that would have followed if AIG had failed to pay its counterparties, many of which were the same major banks that were already in trouble. The story of the short sellers illuminates something important about what markets actually are. They are not truth-revealing machines that always price assets correctly. They are systems in which many participants with different information, different incentives, and different time horizons interact to produce prices. When the incentives of the majority of participants are distorted, when the people doing the analysis are paid by the people whose products they are analyzing, when the people holding the risk are confident they can transfer it to someone else before it materializes, prices can diverge significantly and persistently from underlying reality. Recognizing this, holding the humility to consider that prices might be wrong, that the consensus view might be distorted by structural incentives, that the products rated AAA might not actually be safe, is not a sophisticated insight available only to specialists. It is a basic discipline of financial skepticism that the story of 2008 illustrates with painful clarity. And with that, we have covered everything. 22 parts. The housing bubble, the subprime loans, the securitization machinery, the CDOs, the rating agencies, the leverage, the trigger, the week that changed everything. The global contagion, the panic, the rescue, who paid, the damage to real lives, the reforms, the lessons, the people who saw it coming, the human story, the political consequences, the historical context, the lasting lessons, the incentive structure of the system, and the short sellers who proved what everyone else refused to see. What ties all of it together is simple: a system whose incentives pointed in the wrong direction produced a predictable catastrophe. And the people who had built and profited from that system were largely protected from the consequences, while the people who had trusted it were not. That is the story of 2008, and it is a story worth knowing, because the system has not been fundamentally redesigned. It has been adjusted, moderated, somewhat constrained. But its essential character, its tendency to generate complexity that serves intermediaries more than end users, its misalignment of incentives between the people taking risk and the people bearing it, its vulnerability to the assumption that this time is different, remains. Navigate it with open eyes, use its genuine benefits, be skeptical of its complexity, understand its incentives, maintain your resilience. If you are still awake, that was genuinely a lot of ground to cover, and I am grateful you stayed for all of it. If you fell asleep somewhere in the middle, perfect. This will still be here tomorrow. Come back for the parts you missed. Sleep well.